I'm from Michigan, a state with notoriously high insurance rates. And despite some major changes to our insurance laws, we still have some of the highest insurance costs in the country. And much to my dismay, I saw a recent news headline that car insurance is going up again.
On the rise again, Michigan's high auto insurance rate, part of a national trend that comes as inflation is also hammering our wallet.
All Michigan drivers are going to be charged more money this year. But this time, it wasn't the insurance companies doing, it was the states. This got me thinking, what exactly is the relationship between states and insurance companies? And why does it seem like regulations on insurance are much more stringent than other industries? When you have car questions, Jerry's got your back. Let's get into it. Insurance has been around in the U.S. since 1752, when Ben Franklin created the Philadelphia Contributorship to protect people in the case of house fires. In the next 100+ years, more types of insurance became mainstream for more risks, like work-related death or disability, and eventually vehicles like cars and planes. Even before automobiles became mainstream, insurance companies were getting really powerful and starting to cause trouble. By the mid-1800s, some were trying to become monopolies, edging out all competition so they could force people to pay high rates, while others were essentially operating like Ponzi schemes and didn't have the money to pay out customers' claims. New Hampshire appointed the first insurance commissioner in 1851 to address this problem, and other states soon followed suit. But since the US is a decentralized, federalist nation, we had a debate about whether the national or state government should handle insurance regulation. In 1869, the Supreme Court ruled that insurance is not a transaction of commerce to be handled by the federal government, so it became the responsibility of the states. The court actually reversed this position in 1944, but by then it was too late. The McCarren Ferguson Act of 1945 solidified that states should continue to regulate insurance and that this was in the public's interest. The way states have gotten so intimately involved in the insurance industry actually benefits citizens, the government, and the insurance companies themselves. State interference prevents companies from taking advantage of the public with exorbitant rates, ensures that policies are understandable to the consumer, and makes sure that low-income or statistically risky people to insure also have access to insurance. But the state also has an interest in maintaining the solvency of insurance companies, which is their ability to pay out claims for the policies they write. In fact, states have even created their own organizations that will reimburse insurance companies in the case of really major claims like natural disasters, which is like government insurance for the insurance company. This means that sometimes the state could theoretically make consumers pay higher insurance rates or extra fees to keep their own insurance for the insurance companies afloat. Okay, that's a lot of conceptual information, but what does this look like on the ground? Basically, insurance companies have to consult with each state they operate in every year when it's time to set a new rate. And different states have different approval systems. The strictest states make insurance companies file a proposal for exactly how much their rates will go up, say why, and the state has to approve that exact number. Other states allow insurance companies to change their rates however they want as long as the change is within a certain amount or percentage. And more relaxed states simply trust the idea of market competition, letting companies largely determine their own rates. They know that it's against an insurance company's best interest to charge more than the going rate because that will drive away customers. Like I mentioned before, state governments regulating insurance is conceptually good for consumers and our economic system as a whole. States make sure that insurance prices are fair and accessible, but also that the insurance companies will be able to pay out claims in the case of major disasters or events. But even if states can keep rates from going too high, they can't stop insurance companies from increasing their rates to meet the demands of challenging markets like the one we're facing today. Which is where Jerry comes in handy. We can help you score the best insurance rate if you're looking for a new policy, or simply give you the confidence that you're not overpaying. Whatever you need, Jerry's the app that's got your back.
Jerry, the all-car app that's got your back. Because we car.